Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data. Right now, the public exchange price looks completely flat. Most retail investors are disengaged, waiting for a drop. But stay with this analysis until the end. The numbers happening beneath the surface point to a specific, highly orchestrated repricing event scheduled for this coming Monday. We are currently tracking the most aggressive institutional front-running maneuver in the history of this asset. In the last 10 days, we have watched a staggering supply blackout unfold. Exactly 490.8 million tokens have been permanently removed from the tradable float. I am going to show you the exact leaked valuation model behind an $8.12 collateral floor. But first, you must understand the massive trap being set for you right now. The psychological game operating this weekend relies entirely on a price illusion trap. Retail investors look at the visible order books, see zero momentum, and assume institutional indifference. That assumption is mathematically incorrect. Quiet markets are exactly where smart money accumulates. The flat public price is actually a manufactured condition. It is the direct byproduct of off-market accumulation mechanisms. Institutions are routing supply straight from the flow into deep cold custody, avoiding the visible exchanges completely. They use limit buy walls to cap downward movement, ensuring retail gets bored and walks away. When you feel the urge to sell because the chart is not moving, you are reacting exactly how quantitative algorithms modeled you would. Waiting for mainstream news networks to tell you what to do is a fatal trap. Holding physical XRP right now is the only mathematical defense against this orchestrated supply squeeze. Every token you sell today goes directly into the vaults of US family offices and private wealth desks. These entities are aggressively securing positions before Monday, fully aware of the political announcements pending in Washington. They possess the data that you do not see on your phone screen. Your decision to hold is not based on blind faith, but on the verification of structural accumulation. You are positioned ahead of a legal classification event that will permanently alter US financial infrastructure. Relinquishing your assets on a quiet Sunday afternoon is exactly what Wall Street needs to complete their balance sheet requirements. Protect your position, because the numbers coming out of the over-the-counter markets right now are unprecedented. Let us look at the actual over-the-counter data from London and Singapore. Major institutional OTC desks are currently quoting XRP at a massive 35.4% premium above public exchange prices. This represents the largest decoupling of institutional and retail pricing in the history of the asset. These sophisticated buyers are paying 35% more than you would pay on a public app. They are willingly accepting this premium because they know the actual value of incoming US regulations. Add to this a verified 22% spike in weekend buy-side interest across institutional channels. They are not front-running a standard trade. They are pricing in the immediate regulatory shift. The institutions are absorbing the available supply at a premium because they mathematically understand what happens when the public float dries up entirely. This massive premium is directly tied to the supply squeeze I mentioned earlier. Over the last 20 hours alone, another 28.4 million XRP left centralized exchanges in a total vacuum. This pushes the cumulative 10-day drain to that 490.8 million figure, bringing the tradable float near a total blackout phase. To execute this, institutions are spinning up fresh architecture. 3 new mega wallets were established just today. Each wallet holds exactly 15 million XRP. These were not random retail transfers. They were funded via a single Tier 1 institutional gateway. This uniformity is the exact fingerprint of programmatic institutional hoarding. They are setting up perfectly balanced settlement accounts to handle the incoming liquidity demands. The float is shrinking precisely when institutional demand is scaling up to handle institutional bridge transactions. The underlying reason for this aggressive accumulation is a newly leaked valuation model from top-tier investment analysts. This math establishes a structural collateral floor of $8.12. This calculation models the strict liquidity requirements for XRP to function as the primary settlement asset in a projected $35 billion daily US institutional trade corridor. To push $35 billion through the ledger every single day, the asset requires deep liquidity. If the price is too low, large transactions suffer from high slippage, which destroys the cost efficiency of the network. Therefore, XRP's structural price floor must absolutely absolutely reach $8.12 to support this volume natively. This is not a speculative target, it is a mandatory operational baseline. Without that floor, the daily US institutional settlement corridor simply cannot function under regulatory standards. The urgency behind this math brings us to the actual physical movements of Ripple leadership this weekend. Senior executives are currently holding final, closed-door weekend briefings at Teterboro in New York. They are sitting directly with the technical staff of the DTCC and the Federal Reserve. You do not hold emergency weekend briefings with the most powerful settlement authorities in the United States unless an operational launch is imminent. They are ensuring that the ledger settlement rails are fully integrated and stress-tested. The institutional volume spike expected to hit the network requires absolute operational perfection. Holding through this weekend is critical because retail investors are completely blind to these integration meetings. The architecture for the $35 billion corridor is being finalized, while retail traders debate fractions of a penny. To guarantee the stability of this new infrastructure, Ripple has deployed a brilliant financial mechanism using their RLUSD surplus. Their 105% Treasury collateralization surplus is now generating an estimated $8.2 million per week in pure interest. They are not holding this as idle cash. This capital is actively funding a dedicated Liquidity Provision Fund. The sole purpose of this fund is to guarantee zero slippage for institutional bridge transactions during high volatility events. It acts as a massive shock absorber for the network. When Wall Street pushes billions through the ledger, this fund ensures the trade executes perfectly at the mathematical floor. The Treasury yield is literally paying for the liquidity backstop required by the largest financial institutions. It is a self-sustaining loop of institutional capital efficiency. All of this hidden math and accumulation is converging on a singular political event, scheduled for tomorrow. Political insiders in Washington have confirmed that a Monday morning presidential executive order is fully locked in. This specific order utilizes Section 6 of the Clarity Act. Its purpose is to formally certify XRP as a strategic national digital commodity. That legal certification grants the asset absolute immunity from SEC securities enforcement for secondary market trading. The moment that order is signed, the final layer of regulatory ambiguity evaporates. Every pension fund, sovereign wealth manager, and bank trust that has been waiting on the sidelines will have the green light. The 35% OTC premium exists because Wall Street knows this Section 6 rollout is only hours away. The ecosystem is already proving that this utility works at the highest levels of traditional finance. A technical log from a recent private banking pilot was just reviewed. It confirms the successful execution of an atomic swap between tokenized US Treasuries and RLUSD, using XRP as the intermediary bridge. This is a monumental ecosystem bonus. The transaction recorded absolutely zero counterparty risk. Tokenized US Treasuries require the strictest compliance frameworks in the global fixed income market. Achieving zero counterparty risk in a live production environment validates the entire ledger infrastructure. It proves that the network can replace the outdated legacy settlement systems currently failing Wall Street. The banks now have mathematical proof that the technology functions flawlessly under massive regulatory scrutiny and institutional scaling constraints. To complete this institutional takeover, David Schwartz just confirmed a massive update regarding credit infrastructure. The native on-chain lending protocol is currently undergoing its final mainnet staging tests. They are conducting these tests with a specific group of 5 partner banks. This protocol is the missing piece of the puzzle. It opens the door for automated, under-collateralized institutional credit lines directly on the ledger. Banks will be able to access deep liquidity for settlement transactions without carrying heavy balance sheet risks. Once these 5 banks clear the staging phase, the floodgates open for broader US banking integration. The technology is built, the banks are testing it, and the legal framework arrives tomorrow. You are watching the complete rewiring of the American financial system happen in real time. The entire picture is now clear, and the data is irrefutable. We have a 490 million token supply squeeze, a verifiable 35% OTC premium, and a mathematically required $8.12 collateral floor. The DTCC and Federal Reserve are finalizing integrations, while a presidential executive order sits ready for Monday morning. The retail investors selling their bags today are funding the institutional settlement accounts of tomorrow. You now have the exact data that the smart money is using to execute their accumulation programs. Do not fall for the quiet public charts. Trust the hidden math, respect the supply drain, and understand the magnitude of the infrastructure being deployed right in front of you. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.